Welcome back. You're still watching Business Morning on Channels Television. It's the first edition of the program for the week, and we're continuing our discussions on sessions and various sectors that will be focused on at the World Economic Forum Africa meeting, which comes up next month in the Federal Capital Territory, Abuja. It is the first time that Nigeria is hosting it. It's the 24th edition of the meeting, and it's a good time also for Nigeria. Now, so many discussions have been ongoing as regards what should be the outcome from most of the participants who are going to be sharing ideas at this meeting. And so today on the program, we're going to be looking at one of the sessions that will also be discussed at the meeting, which is on financing growth. What is this all about? Well, to talk more about it and how financing growth is really important in ensuring a robust and inclusive growth in Africa, not just in Africa, of course in Nigeria. I'm being joined on the program by the Group Head Development and Project Finance of Heritage Bank, Mr. Olusegun Akonji. He's to my far left, and to my immediate left is the Managing Director, Chief Executive Officer, Carry Assets Management Limited, Mr. Johnson Chukwu. Good morning, gentlemen, and thank you for coming in.
Good morning.
Well, it's a beautiful Monday morning, and it's, as is usual, we should talk plenty money and how it will impact positively on the economy. But now let's talk about the World Economic Forum Africa meeting. We've been talking about this in the last couple of days now, and we've looked at various sessions that will be talked about. So today, let's talk about how this theme, forging inclusive growth and creating jobs, is important in terms of providing basic infrastructure. You cannot talk about these two things without talking about basic infrastructure. So, Mr. Akonji, how can financial services support inclusive growth?
Thank you very much. I think at the moment, we've gone beyond just issuing cash out as credit to people. We've seen the outcome of that. We need a lot of innovation coming into understanding the structure of the kind of population we're going to be having going forward. We must understand what education people are having, what kind of interest they have, and what they want to do. That way, we're able to give them the kind of financial support that they need. And we must get to the point where our banks go beyond credit issuance to delivering advisory services, to the extent that as people come up with institutions that they want to form, we create opportunity for them to source this financing beyond our confines. So we could source money outside Nigeria for institutions who think they do not have hope. That my business cannot go beyond the borders of Nigeria. I actually could link them up with institutions and people that are interested. Because that's a major challenge that we have. Because people are not interested in opening up their businesses. So you'll find a situation where I manage my business, and then after a while, you talk about some institutions that we never see again in Nigeria. Local multinationals that have just disappeared. So it's about bringing advisory into the financing system. That way, we can support businesses and put the right cash in their hand all the way through.
Mr. Chukwu, advisory services. Mr. Akonji just mentioned it. That's what Carry Assets Management Limited actually does. Now, in terms of providing advisory services, could you just comment on what inclusive business financing is really all about? Is it the same as development finance, for instance?
Well, it's not exactly the same thing as development finance. Development finance is an intervention mechanism where the regulatory agencies or government, in the case of Nigeria, central bank, we provide funding to critical sectors of the economy as suboptimal or below market rates. That's what we talk of development finance. It's slightly different from what we're saying. What he's talking about is providing advisory services to those who are assessed funding so that they be in a position to run their businesses efficiently or successfully. What he did mention is that there are several Nigerian organizations that grew that should have grown and metamorphosed into conglomerates, but they died with the exit or the death of their founders. And because there was no structure to sustain the operation. But beyond that, we also have to look at other aspects of inclusive growth. And that is one area he mentioned somehow, the issue of credit availability. If you look at what countries like Bangladesh did with microcredit and what Equity Bank of Kenya has done in terms of providing credit, the segments of the society that we are unable to access credit, that we are regarded as unbankable. I think that's one of the areas we need to look at. Because one critical factor you have to look at is that for you to reduce the level of poverty, for you to have inclusive growth, you need to allow more people to have access to the financial system. More people should have access to credit. Beyond credit, other financial services. People should be able to use the tools of financial services to do their business. And that helps those who are the lower rung of the ladder to climb out of that situation.
Okay.
So we need to look at how do we make credits available to a larger proportion of the Nigerian population. As far back as 2004, the number of very poor in Bangladesh that had access to credit was about 13 million. Today, we have a system that should provide credit to the unbanked sector, the microfinance system. Are there constraints that the microfinance systems have that we should be looking at? We've moved from People's Bank to Community Bank and now to microfinance banks. They are all, if you look at the objective, they are all about the same thing. But the key thing is that I don't think we've gotten it right in terms of strategy. And I can tell you some of those strategies we got wrong that we need to begin to address if we have to have inclusive growth. And we can leverage on what other countries have done successfully, like what Bangladesh did successfully, what Equity Bank of Kenya has done successfully. How do we provide credit to those who do not have the collateral? How do we provide credit to those who are not highly literate as to prepare a business plan? How do we secure such credits?
So I think we should now ask Mr. Akonji that question. We have a large population of unbanked in Nigeria, and Mr. Johnson Chukwu has just also highlighted that. Of course, the Central Bank of Nigeria has tried as much as possible with its financial inclusion strategies and the rest of it. But apart from that, what other models can be adopted to ensure that the unbanked become banked?
First and foremost, we need to answer the question, should we direct credit to that sector? We can direct financial services to the extent that they have access to utilize banking or financial services facilities, bring in their money and all of that. Now, the next question is, can I give credit to them? Because actually the rotation of credit, the transitional pipe of credit is what creates wealth. Now, you need to be able to dissect the population. No, we hear about the bottom of the pyramid. Where really is the money in that pyramid? The first thing is, if you look at some of the studies that have been done by Frank Hallard and Stuart on this bottom of the pyramid stuff, what you get is that about 5 billion population of the world have wealth of about 5 trillion. Now, if you just divide that, you find that it's just $1,000 per person. Now, if you come to Nigeria, apply the same population and the same percentage, you will probably have Nigerian population of about 110 million people in that category. No, you can tear them. Which means that if we use the same $1,000, you have $108 million available to that sector. If you use the current rebasing of the GDP, which reflects distribution of national wealth, if it's representative of it, it means every Nigerian should have at least $2,000 to spend.
Or slightly over $2,000.
Or slightly over, which gives you then over $216 billion market, which is about 40 trillion. Now, that will be enticing. But the pattern of distribution has to be clear. Now, for institutions like ours, for example, we have modeled a situation, a system where we can actually deliver credit to people without collateral. Now, the central bank has said, okay, created a system where people do not need to have minimum balance to open accounts and all of that. But really, what about the cost of dormancy? So you need to look at all of these before you open the shop to everyone. And when they come in, or when they do come in, which of them will require credit?
But then, why does it always seem to be that the banks, the big banks, should be given credit to small businesses, for instance. Why, like, Mr. Chuku actually pointed out, what role now does the microfinance bank play in all of this? It seems as if, in fact, they've been relegated. Nobody really goes to the microfinance banks anymore, because if you go to the microfinance banks anyway, they give you the loan at the same interest rate as a normal bank would. And so why don't we just go there anymore? So it seems as much as possible we do not see an active role of the microfinance banks anymore. It seems as if it should just probably be scrapped, or they should actually merge or be acquired by these other banks and just be the bank that the businesses will go to get loans. Mr. Chuku, do you want to comment on this?
Well, yes, I'll comment on that. You see, the microfinance bank we actually set up to attend to specific needs. Like you rightly said, it seems that those needs are not being attended to. And there are factors that relate to that. One, the location of the microfinance banks, or the microfinance banks, and their target market have been the same target market that the conventional banks are pursuing. So you have a wrong focus on the target market. And because they have a wrong target market, they have also put the structures to service the target market, their so-called target market, which includes things like buying expensive cars, locating in highbrow business districts. The microfinance banks are supposed to be located at the doorsteps of their natural target market, which are the lower, those in the lower rung of the ladder. And if they do that, the key thing about setting up microfinance bank, they should have a clear understanding of the customer base, of their customers. And that clear understanding will come with interacting with their customers. I'll give you an instance. If you look at what the microfinance bank did in Bangladesh, they formed their borrowers into unions, something like cooperative unions. And each of the borrowers undertake, the group will kind of guarantee themselves. So if we lend to you, and then your group members will guarantee you, and then you have a peer pressure on you. So you find it difficult to default. But beyond that, the lenders are within your community. They know that you're either a rice farmer, or a shoemaker, or a furniture maker. So when you make your sales, they know you've made your sales. On a weekly basis, the unions come together, have meetings and say, look, this is how business is going. They're having challenges. The bank is put in the know, and the bank could actually assist them work out their difficulties.
Okay.
So that has been lost in the case of microfinance banks. The key thing that we need to look at are the microfinance banks serving their primary objective of existence. I think that has been lost. Are they located where they should be located? Do they have the cost structure that will support servicing those who need their services? If you have a very high cost profile, you cannot provide microfinance services to those who want to borrow 100,000, 20,000, because the cost of servicing such loans will be very exorbitant. The other factors you have to look at: do we have macroeconomic stability? Interest rate is going down, inflation rate is going down. Those are two critical factors you need to have a viable microfinance system. Because once you have a hyperinflation, it becomes impossible for those who are borrowing at those high rates to pay.
Okay.
Probably you take your question, then we advance.
No, let's even just take a quick breath now. Take a quick break to catch our breath. And then when we come back, you've talked about the microfinance banks. We've talked about the big lenders. What about looking at the possibility of sourcing finance from another method? The capital market, for instance. Private equities, for instance. So let's hold on to that thought, and we'll come back and continue this conversation.